rate is 8% of this new debt that we borrowed, and this debt was issued at par, then we know the coupon rate of 8% is also equal to the yield to maturity. So right here, that the yield to maturity is 8%. And why is that important? Well, because yield to maturity is the same as the cost of debt. So that is going to be used in the calculation of the weighted average cost of capital. So that's the first one. In this video, we're going to take a quick look at the efficient market hypothesis. That's often shortened to EMH. We might also hear it called the efficient market theory. Now, the efficient market hypothesis is an investing theory made popular by Eugene Farmer. He's a professor and famous economist. Okay, well, as some of you may know, some have been following this channel for a while, I'm actually working towards my doctorate in financial management, and in a recent school assignment I had to create a short video on, you guessed it, the efficient market hypothesis. Well, my professor came back, he gave me an A, which is awesome, and since I did all the research to understand the theory, I figured it might make sense to share it with our community as well. Since, after all, the efficient market hypothesis is one of the more popular investment theories out there. Okay, so the assignment was to present to a group of hypothetical investors the efficient market hypothesis and to explain the basics of the theory and to provide conclusions and recommendations for those investors to consider for them to better get an overall understanding of the theory. Okay, so now we'll jump into that presentation, and then I'll be back once that's over with an additional thought that was slightly outside of what the assignment was asking for, to just sort of expand on the efficient market hypothesis. Okay, here we go. In summary, the efficient market hypothesis says that the price of a stock fully reflects all of the publicly available information out there. And since the current price of that stock reflects all of the information out there, well, it's only the new information that will ultimately move the price of the stock. And the efficient market hypothesis goes further by stating that since a stock price already reflects all publicly available information, it's impossible to beat the stock market from a performance perspective over the long run. Unless, of course, we have more than publicly available information. Something like insider information would be very helpful, but of course illegal. Now, there are many arguments both for and against the efficient market hypothesis. So let's look at both so we can get a well-rounded view of the implications of this. So those who support the efficient market hypothesis say that fundamental analysis is pointless, or were mostly pointless, since once the information becomes available, it is quickly reflected in the price of the stock. Along those same lines, technical analysis is equally as useless, since the past cannot be used to predict the randomness of the future. So, if there is a stock available today for $20 a share, according to the efficient market hypothesis, that is its fair value. So any research we might conduct would be simply pointless, since the market is reflecting the current fair value of the stock. There's simply no way to identify a fair value that is more accurate, since all of the information that could be used to calculate the fair value is available to the public and therefore already priced into the stock. Okay, so is this true? Well, Eugene Fong, the pioneer of the efficient market hypothesis, well, he identifies three relevant subsets of this hypothesis. We have the weak form, the semi-strong form, and the strong form. The difference between each of these three levels is what information is useful and what information isn't useful. In the weak form of the efficient market hypothesis, the price of the stock is believed to reflect all currently available market data, and therefore technical analysis would never work, since technical analysis essentially relies on history repeating itself. Although fundamental analysis at that level could work. Then we move over to the semi-strong form of the efficient market hypothesis. At that level, the price of the stock is quickly adjusted based on new information. That could be news articles, analyst reports, earnings reports, either directly about the company or perhaps about a competitor. Either way, the stock reacts very quickly. So at this level, fundamental analysis can't be used to achieve risk-adjusted returns that are superior to the broader market over time. Then we have the strong form of the efficient market hypothesis. In the strong form, the theory is that the stock prices reflect all of the available information. This level implies that no investors can beat the broader stock market on a risk-adjusted basis over the long run. Now, the reason that I continue to mention that investors can't beat the market on a risk-adjusted basis is that the theory is if an investor is willing to take on more risk, surely they can achieve higher returns. This hypothesis does not dispute that. But the key is that those investors took more risk, and therefore they should be compensated for that additional risk. So the efficient market hypothesis doesn't negate investors who want to get a higher return and are willing to take risks to get there. Ultimately, all it's saying is that over the long run, stock prices reflect all publicly available information, and therefore, since we all have access to the same information, no one can consistently beat the markets. Now, our question is, does this hypothesis actually hold true? Well, when we look at the strong form of the efficient market hypothesis, we can say that with almost certainty, this doesn't hold true. The strong form states that the price reflects all information. That's public and private information. Now, there have been multiple studies that have proven that private information, also known as insider information, can allow for investors to consistently beat the average returns of the market. Hence, that's the reason that insider trading is illegal in developed markets. So clearly, that form doesn't appear to hold true. Then the semi-strong form, well, this is where things get a bit more interesting. History has proven that value investing, as determined by a stock's PE ratio, well, value investing on average has outperformed the market in the long run. This would imply that fundamental analysis and spending time coming up or calculating the fair value of a stock does in fact lead to higher potential returns. And then when we switch over to the weak form, well, empirical evidence has shown fairly confidently in this case that this is true. It seems that investors cannot consistently beat the market using only historical data to forecast future price movement. So how accurate is the efficient market hypothesis? Well, it seems that in a developed market, the truth would lie somewhere in this area. Strong form appears to be straight up wrong. Weak form appears to be accurate. And the semi-strong form can work, assuming an investor knows how to correctly interpret information and keep off the bandwagon. So an investor's best move, according to Eugene Farmer, is to buy low-cost index funds and simply take what the market gives us. Anything beyond that is useless. That's according to the efficient market hypothesis. Yet some investors, Warren Buffett is often cited as the key example, well, they've proven that fundamental analysis has a place in investing. Therefore, investors must examine their own intentions and skill set within the world of investing and choose their investments based on the goals of a truthful reflection of their skills and emotional discipline. Okay, so that was the end of what I submitted for the school. I had a small ending at the end, but whatever. The only other point I think is worth mentioning here is that clearly the conclusion that I came up for that assignment was that the actual world of investing lands somewhere in this area. And in my mind, that is very true. Now, yes, in the efficient market hypothesis, this implies that technical analysis doesn't work at all. But I'm not 100% sure I completely agree with that. Personally, I'm not a big believer in making investment decisions based solely on technical analysis, but I'm not sure I would call it useless either. So I think it makes more sense for us to focus on fundamental analysis, and if we're using technical analysis at all, I think it could be inserted into our broader fundamental analysis process. Now, I actually did a video called The 8 Steps to Analyzing a Stock, and in that video, I focused on the process behind fundamental analysis. And if we're looking to develop our own process for analyzing stocks, perhaps that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.
What is the efficient market hypothesis? The main idea behind the hypothesis is that the prices of traded assets
Hello. Good cat. Aren't you a good cat?
stocks already reflect all publicly available information. And thus, if you're investing based on publicly available information, you won't be able to systematically outperform the market over time. Think about it this way. On average, buyers have just as much information as sellers, and vice versa. So that means a stock is just as likely to overperform the market as it is to underperform. Stock returns are hard to forecast because old information is already incorporated in stock prices, and new information is by definition unexpected or random. Here's an example. At 11:39 Eastern Standard Time on January 28, 1986, the Space Shuttle Challenger exploded in great tragedy, killing everyone on board. 8 minutes later, that news hit the Dow Jones wire service. Things were a lot slower back then before instant messaging. On that day, the stock prices of all the major contractors who had helped to build the shuttle, such as Morton Thiokol, Lockheed, Martin Marietta, and Rockwell International, all fell immediately by 2 to 3%, except for Morton Thiokol, whose prices fell by over 11%. As it turns out, quickly figured out that Morton Thiokol was the most likely cause of the disaster, and within hours, that information was reflected in market prices. A formal investigation would not begin for another 6 months, during which time the failed O-rings made by Morton Thiokol were linked to the cause of the disaster. Now that was back in 1986. Nowadays, new information starts to change markets, not in hours or minutes, but in seconds or milliseconds, literally faster than the blink of an eye, making the efficient market hypothesis that much more efficient. To learn more about the stock market and how it functions as an economic institution, click here.
Hello and welcome back again to MBAbullshit.com. So the topic of this video is
I'm reading.
efficient markets hypothesis.
Sorry, 1
also
second.
known as the
I'm reading Necromancer by William Gibson. What are you reading today? And have you seen my recent YouTube videos? That's what I want to ask.
This is the basic video before we move on to a more advanced video on the efficient markets hypothesis. Remember, you can
Hi, I'm Alex, and I'm going to be your tutor for this section on the efficient market hypothesis. The hypothesis comes in 3 forms: the strong form, the semi-strong form, and the weak form. And each imply that information at different levels is impounded in stock price. Now, when we talk about efficient markets, what it means is that the amount you pay for a stock or another security, and the return that you get, when discounted based on the amount of risk that you have, will give you a net present value of 0. In other words, there is no way effectively to beat the market consistently. So let's look at the 3 forms. Strongest form says that all public and private information is impounded in the price of a stock. That means that even if you could get hold of inside information, like Gordon Gekko would do in the movie Wall Street, that you couldn't still beat the stock. In practice, this is probably not true. There are constantly cases of rings on Wall Street using privileged information in various ways to get an edge on stocks. For example, getting information about earnings prior to when they should be released during the embargo period, getting early results, for example, of drug trials when they are still confidential and private. Those sorts of pieces of information still can apparently make money, and as a result, high-profile rings investors have been caught at some point by the SEC who are involved in tracking down these sorts of cases. Most likely, therefore, that the strong form is probably not true and that it is still worth trying to get inside information, although most of this is in fact illegal and certainly unethical. The second form is the semi-strong form, in which all information is in the price. Now, information in this case means historic information on annual reports, anything in the news that's been published, anything that the company says that is available to everybody. It's the sort of information that analysts at brokerage companies and investment banks pore over, looking for small pieces of information that might not be impounded in the stock price. As an ex-analyst myself, my experience has been that, in general, it is not possible to do better than the market in terms of analyzing stocks. Sometimes you get, apparently, you made a good guess or a good call on the stock, and it goes the way you want it, in which case it looks like you're doing well. In other cases, you make bad calls and it doesn't work. Now, occasionally, some people have done very well. Whether they're consistent or not, it's difficult to say, but a good example would be Paul Chanos, the investor, who guessed rightly that the CDOs that were being sold prior to the financial crash were in fact overpriced because their grade levels were too high, as analyzed by S&P and Moody's, and as a result sold short on the market, and when it collapsed, made out pretty substantially. But in general, information that's public is immediately impounded in the stock, and it does change very quickly. If a news headline flashes across the screen that something's happened with a company, the stock price will move in the direction that you would expect very rapidly to impound that information. that's really essentially saying that it's very, very hard to beat the market without having some way to execute very, very quickly. Today, high-frequency traders kind of do that by essentially putting in orders that can effectively front-run information, so that if you a news headline that said that it's a very favorable piece of information about a company, fairly quickly after that, orders will be put in to buy that company, which will then push the price up to meet the new expectations. If you can push your order in such a way to get in front of those orders, you can make money in that sense. But this is essentially front running, which is not really a legal activity. The last form is fairly simple. It's basically saying that historic prices have no information in them to tell you where the future goes. Now, there are people called technical analysts who will take pricing information and indeed other information like volume and so on, and they will try to find patterns in that will divine the future. So they will use forms like head and shoulders and double tops and triangles as patterns to indicate where the future of the stock is. Other analysts will use things like moving averages and whether the stock is moving above or below the moving average at any given moment to indicate where the stock is likely to go in the future. This has been fairly easy to test in the past, and effectively it turns out that it is next to impossible to make any consistent gains in mispricing and guessing where the market's going to be using historic price patterns. Usually, if one tries it oneself, one finds that there does appear initially to be some gains to be made by being clever with the use of past information, but then once you apply transaction costs, all those profits will then disappear very quickly. Now, people do believe that you can do this, and so there is quite an industry out there of